Interest rates are on the rise. This week, we've seen the US increase interest rates to about 2.5%. Last week, we saw Europe increase interest rates all the way to 0%. And the week before, we saw a hike in the UK, bringing interest rates over 1%. So interest rates across the board are on the increase. Baylee, the question I'm getting asked the most at the moment is about the relationship between interest rates and inflation. The theory is that you increase interest rates and you curb inflation. I want to find out if that's true, and I also want to find out where interest rates are going. But let's start off with the first question. Do increasing interest rates actually stop inflation?
Well, they can certainly help. To put it simply, rising interest rates increase the cost of borrowing money. Both individuals and businesses are put off from borrowing, like taking out a mortgage, for example, or spending, as there's now an incentive to leave money in a bank account to generate some interest. And that's why rising interest rates are used to dampen inflation. For example, in the 80s, we saw the Fed funds rate increase to around 20% on a few occasions, which helped to drive inflation from around 15% down to 2.5%. We've seen the reverse of this as well post the financial crisis, where interest rates were cut to try and increase growth and inflation, which somewhat had the desired effect of stabilising growth. So interest rates have shown to be effective, but we're going through a period of inflation, but yet slowing growth, which is the challenge central banks are facing. If we had increasing inflation and increasing growth, it would be a lot more straightforward to increase interest rates until we saw that inflation subside. But instead, central banks are trying to increase interest rates, but have to have a very, very close eye on tipping the economy into a recession.
So how high can interest rates go? I mean, what's our expectation?
This is a really interesting question, as market expectation differs per region by a peak rate and by when it will peak. The market is currently pricing a rate of around 3.5% at the end of the year for the US, a bit over 1% mid next year for the Eurozone, and a rate of about 3% for the UK early next year. Of course, this is what markets are saying right now, and that can change quite quickly.
Okay, interesting. So different points they will peak out and at different rates. I mean, will it be enough to curb inflation?
In short, we do see inflation dampening, but the story is not just about interest rates. Some of the big headwinds are energy prices, commodity prices, and supply chain issues. And these are some things that won't be solved overnight, but we can see a pathway where they could subside, which could start to bring inflation down. Regionally, on one side, you have the US, which may be nearing peak inflation now. And on the other hand, you have Europe, which is going to be heavily determined by energy and gas pricing because of Russian supplies. And then UK sits in the middle. Although the UK doesn't hugely rely on gas from Russia, it's more impacted by the slowdown in Europe than the US is.
Okay, I mean, what does this mean for markets? And in particular, I'm interested in bonds.
Sure. So this year, we've seen a large fall in bond valuations due to the market pricing in those interest rate hikes. And as interest rates go up, yields go up, which means that bond prices go down. For example, we've seen the 10-year yield for UK gilts increase from around 0.6% this time last year to around 2% today. The numbers I mentioned earlier show that this is already priced into bond valuations, which is that's important for investors to be aware of. And now in the past few weeks, we've seen some degree of stabilization in the bond market.
Yeah, and I mean, I think that's a good message maybe to leave it on. You know, we have seen some stabilization. It's important to keep in mind that the rate hikes that you talk about, you know, they are the market expectations that are already baked into the price and fixed income markets, which is helpful. But it's also true to say, and I know you've mentioned this, that it's a point in time. These things change very quickly. And luckily, we have a weekly series where we can keep people updated. So as and when things change, we will keep you up to speed. Baylee, that was great. As always, crystal clear. Hopefully gets everyone up to speed on where interest rates and inflation are at. We will be back next week. We will put a fund manager on the spot. We'll ask the difficult question and we look to do it all in about 5 minutes. Until then, see you next week.